Did you commit to another CPA review course that just isn't aligned with how you learn? Well, spilled milk, baby. In the world of accounting, only one figure matters, and that's the bottom line. So by investing in Universal CPA Review, you're investing in yourself, and we promise to do everything in our power to get you the ROI that you're looking for by obtaining your CPA license. We know that purchasing a CPA review course is an investment, and we also know that spending all that money on a program that hasn't worked out sucks, and we want to soften that blow. Our Spilled Milk program will allow you to commit to Universal's Visual Learning CPA Review program at a steep discount. So reach out to info@universalcpareview.com to learn more about our program and what discounts you qualify for. All right, so now thinking about some of the more miscellaneous revenue recognition items that might show up on your exam. So we have to be somewhat familiar with these items, right? There's a chance that some of these specific arrangements that companies can enter into can show up as a journal entry. They can show up as a more conceptual type question. But bottom line is there is something here that could be fair game. All right, so we're going to talk about the concept of sales, returns, and allowances, repurchase agreements, consignment sales, bill and hold arrangements, principal-agent relationships, and warranties. Okay, so these are a little bit unorthodox, a little bit unconventional type arrangements that can definitely occur throughout the ordinary course of business for a company reporting its financial statements. Okay, so we're going to attack these each individually and learn the little details about all of them. All right, but at the end of the day, if this is something that you're not totally understanding, don't pull your hair out over this. This is something that can be more miscellaneous on the exam, but has definitely shown up in the past. All right, so firing this up with sales, returns, and allowances. This one is the most common, okay? So this one is sort of similar to what we're going to talk about when we discuss warranties, but this is even more basic than that. Okay, so warranties are going to have different types of warranties, and this is not going to be the case with sales, returns, and allowances. When it comes to sales, returns, and allowances, we should be considering that customers have the right to return certain products for various reasons, right? Maybe the product was defective. Maybe they were unsatisfied with the product. Okay, so let's say that Yeti Inc. is selling computers to customers, but they provide them the right to return the product. Okay, so they can either do this, let's say, as a full or partial refund, might offer them a credit that can be applied against amounts owed, or they might allow them to exchange the product for another product. But what's key to know for the exam, and ultimately for financial reporting purposes, is this is one of the special transaction arrangements that will be recorded based on the expectation of revenue that will be retained. Okay, so this is going to be something that Yeti Inc. would estimate on an annual basis. So the amount that the company estimates that will be returned will be recorded in the initial journal entry as a refund liability. Okay, so this is the liability that they expect to return to clients based on historical information. Okay, so the revenue amount that's going to be recorded is going to be net of the expected liability. So this isn't technically going to get reported until the refund liability has been settled. Alrighty, so super basic example. Yeti Inc. typically sees 3% of computers sold to customers returned. All right, so Yeti offers a 30-day refund policy. Company sold $150,000 worth of computers at the beginning of the first month of the year. At the end of the first month, $2,500 worth of computers were returned. Okay, so we're going to record this, as we said, net of the expected return amount. So the initial journal entry for computers sold at the beginning of the first month of the year would be a debit to cash for the $150,000, right? That's the total cash coming in. But the revenue amount is going to be net of that expected return liability. So we expect to return 3% of the $150,000 worth of computers that are sold. All right, so 3% of $150,000 is $4,500. So that is the refund liability. Okay, so the total sales revenue would therefore be $145,500. Okay, so that is the total cash from the sale net of the refund liability. Okay, so that refund liability is going to get reversed when we go ahead and return the $2,500 worth of computers. Okay, so we would debit $2,500 and credit cash for $2,500. All right, no longer have the liability, but we also no longer have the cash from that sale.